Hi and welcome to Centrum's second monthly market outlook for 2025. I have Shankar with me. Shankar, let's discuss the budget. A very important event played out a couple of days ago. A lot of talks going on around in the market about government doing a fantastic job on balancing consumption along with fiscal prudence, the kind of impetus that they have given on consumption, disposable incomes. Your initial reaction on that?
I think this budget, the government has not only been prudent fiscally, like we all are seeing and hearing now, but I would credit them with being more responsive as well. Because as we know, in the last um couple of years now, I think the consumption story in India has been a little muted. There have been pockets of some amount of stress, especially with incomes not rising commensurately with inflation. So I think this move to readjust the tax slabs is a very timely measure. Also, I think after expanding the government's capex by 29 to 30% per annum over the last 4 years, the government is kind of stepping back and saying, let's let that story play out. Let's build out all those programs that have been announced, and in the meanwhile, using the monies that we have, let us put them in the hands of the people to spur the next story of growth. So I think, therefore, I think they have thought through this very well. At the same time, I think in a way, the government capex expectations are probably one should kind of relook at that tall expectation that the market kind of typically has going into the budget. Somewhere I think the government's capacity to kind of implement more and more capex, or you utilize more monies there, probably is coming to a head. So I think that's in a nutshell what it is. But yeah, overall I think this is the central piece, I would think, for the budget as such. But Manish, one thing that is a big debate is you put 1 lakh crore in the hands of people, what are they going to do? And therefore, what is it going to be for which parts of the market?
Yeah.
Until last year, capex was a story. Now this year, people are a little disappointed. So
Correct.
on that part, where do you think, where are these pockets of opportunity? Where are the pockets should go a little lighter from a portfolio, equity portfolio construct?
Yeah, so no, you've nailed the hammer on the head perfectly. The point here is that the overall geopolitical situation globally seems to be a little bit in a flux, especially with the whole tariff war at the brink where we are staring at it. And I don't think India is going to remain isolated from it. If you're going to look at Mexico, Canada, and now EU also coming in that same gambit, then at some point of time or the other, India is also going to come in that bracket. So when sectors like pharma, IT are going to get into a flux sort of a situation, the market will try and look at something other than that, something beyond that, and that's where I think this consumption boost come into play at a very, very timely juncture. So the point here is very simple, which is that if you look at the last couple of years, two things have happened. One is because of the way monsoons have played out erratically, rural incomes and disposable incomes and consequently consumption has kind of gone through a little bit of a flux. And urban consumption in the last 4, 5, 6 months have also kind of tapered down a little bit, thanks to RBI controlling the overall credit growth in the economy, and especially the retail loan book. So with this, the one measure that they have done, which is the 12 lakh thing that has kind of come in, I think that has been superb. Like you said, it is for the first time in 4, 5, 6 years, we've seen actual middle class seeing their disposable incomes increase, especially the salaried class, the urban youth, which is exactly there. So I think sectors which are related to consumption, discretionary consumption, staple consumption, FMCG, I think should get a big boost out of this. So that's where my focus is going to be. But Shankar, if you were to look at it, the bigger positive that I would want to think, where a lot of fear was there, that government would do a whole lot as far as the tinkering around STT, LTCG. There was this thing that they ultimately want to go to 15%, 12.5% is, intermediate and all. A big positive, given that they have not touched anything on that front. So lack of negative, big positive, would you say?
Yeah, true. I think I see. I think they've just done those tweaks last year, and probably let people absorb it. So I think to that extent, I think very wisely they've chosen to tread the stable path. So yeah, that's actually a good thing that they've actually done. But what I think also is something that is there on top of our minds. I think is the fact that like you said, there's a lot of global turmoil that's going on, and we are also trying to find our feet on what is the growth path ahead for us. I think somewhere in that complex, this budget has probably provided that fuel.
Yeah.
But that said, I am conscious about the fact that this fuel that they have provided is going to be a little back-ended, because the tax, the real SOP is going to reach people's pockets probably towards the second half of FY26. So that's really what it is. So I look at it as from a market standpoint. I think the way to probably look at it is that this year is going to be a little up and down.
Yeah.
And one will have to use these periods of volatility to kind of try and see, look at one's portfolio and see if in the past, for instance, it's momentum that played. Last 3-4 years it was really momentum that played. Now going forward, I dare say one will have to relook at that. Similarly, the pockets of capex and infra and all of those where valuations are anyway a little stretched. If incrementally the opportunity is going to be in certain other parts, probably relook at that portfolio. So I would look at this current volatile period as a good opportunity to kind of relook at one's portfolios and reorient them for the new era that we seem to have kind of gotten into.
Yeah.
On that point, Manish, one popular thing that people keep trying to get answers for, especially in the backdrop of the last 3-4 years, is that you saw a period of 3-4 years of mid-small cap tearing rally, and for various reasons we know where we are. But what's your own sense, in terms of that market cap positioning?
Yeah.
How do you look at it, or if that is a paradigm at all to look at things? But how do we kind of parse through that?
No, that's a very, very pertinent question. And, just going back to the point that you said that the orientation of the market for almost 2 years now has been that towards growth. And we've seen the way multiples have kind of expanded, especially in the mid-cap area. And people have been ready to pay insane multiples to various sectors, like, for example, capex, related stories, defense, and all of those areas. And dare I say, at the juncture where we are today in this era of uncertainty, again going back to another point which you mentioned, which is that this is going to be again another year of two halves, like you said, right? As 2024 was, the growth is and the market returns are going to be back-ended. You'll not see a material pickup in earnings growth before the first quarter, right? So it's not going to play out before that. So then in that context, when you're looking at the extended period of uncertainty, I do think that the orientation of the portfolio needs to change more towards value rather than growth at this juncture. And several sectors that have been ignored for a long period of time might actually come back into play. It's a correct time to build up your portfolio, which is going to be more leaning towards large cap rather than mid and small cap, especially try and avoid mid caps, where the valuation still, despite a correction, seems to be fairly insane. Yes, if you have a 7-year view, 5-year view, you can still look at small caps and weather out the pain from the next 5-6 months, 1 year perspective. It's still okay. But if you're looking at 1 to 2 year time frame, my orientation is going to be more towards large cap. I'm going to look at more like sectors, like for example, banks, where the valuation multiple seems to be at multiple year low. Autos, for example, is another one where you're seeing growth coming out after a very long period of time. So bottom-up driven strategy, more leaning towards large cap and value orientation of the portfolio. And like Shankar mentioned earlier, I'm going to use these next 3-4 months to actually build up positions systematically through a STP route, and I'm going to build up my portfolio, which is going to be then ready from the next 3-4 years perspective. So that's how I'm looking at things. Shankar, any last parting words?
No, I think just taking away from that point, you very nicely talked about how the equity portfolio you're going to construct. I'm just going to zoom out a little bit and say overall portfolios, how does one go about it? See, I think somewhere this period is also a time when while the market kind of finds its feet and readjusts across pockets of opportunities, apart from relooking at one's own portfolio and saying that uh, is this portfolio ready for the next 3 years, or is it more like what worked well for the last 3 years?
Yeah.
And I dare say the two are can give very different answers. So I think that's number one. Number two is, I think from our overall portfolio strategy, we kind of are, as you know, we've been a little cautious on the markets for some time. And despite this correction, we are seeing valuations being a little elevated.
Yes.
So I think somewhere we are wanting to see comfort from earnings come back. So until that time, be slightly underweight on equities in the portfolio, large cap oriented, sector rotation oriented, where the pockets of opportunities very quickly keep moving. So tilt the portfolio more towards that. And also, I think finally in the equity portfolio, I would say that look at those ideas which can dynamically manage their equity exposures.
Yeah.
I think that suddenly is become very relevant in the portfolio. So I think that's how we are kind of thinking about it. And on fixed income, I think all of us are expecting that the RBI will indeed be more generous, in this weekend. And therefore, there could be some more joy coming from there. And I think fixed income has a plethora of opportunities, be it credit, be it short-term duration. So it's a very well-rounded portfolio that we think should stand us in good stead through 25 and probably a little bit of 26 as well. But before we conclude, Manish, I just thought we should probably spend a minute on taking stock, and especially now after the very good budget that we have just seen. What is it that's working for us now? Going into FY26. What is going to help earnings growth come back, or the growth picture actually revive?
So there are two parts to it, right? There's a growth part to it, and then there's a valuation part to it. Now there are a lot of sectors, there are a lot of companies where the correction has been fairly intense, far more than what you see at the index level, and which have now started actually slipping down into a value zone, right? First instance, top of my mind, something like large cap banks, right, which are all trading at around 2 or maybe below 2 times, price to book, where you're still going to get about 12-14% kind of a PPOP growth at the bottom line level. I think that's again a zone where is a lot of value, and that is a sector that has been ignored for almost 14-15 months now, right, where the overall allocations have kind of come down very dramatically. So I think that's one area of opportunity from a bottom-up perspective. Wherever you're finding value in the paradigm of value versus growth, the tilt is more towards value. I'd kind of lean towards that. And second is that you have to be very realistic in your expectations as far as earnings growth pickup is concerned. You'll have to start looking beyond Q4. I don't think Q4 is going to be any materially different than Q3, right? Overall, you shouldn't expect more than 5% earnings growth from Nifty in this current fiscal year at all. So whatever hope you have of about 12% or thereabout sort of earnings growth has to be pinned on FY26. So you have to look at sectors which are going to deliver that. Could it be, for example, hospitality? Could it be hotels? Could it be hospitals? Could it be, for example, airline? Could it be, for example, autos? Could it be banks? Maybe pockets of pockets of NBFCs where you don't have exposure to MFI. I think those are the areas where you look at and you kind of build. So that's the opportunity set that at least I have. And the biggest avoid or threat, if I may use that word, that would be for me at this juncture would be very heavily economy leaning sectors, for example, capex related sectors, for example, infra space, for example, defense space, where the focus is going to be far more on execution rather than allocation, right? The shift has already kind of happened and that signal has been laid out in the budget. So that's the way I'm looking at overall things in the market. Well, on that note, thank you for joining us this month, and we hope to see you soon again next month.